Hey there, welcome to XTRM Finance, where we take the scary out of taxes and make money talk fun. Today we're diving into something that affects every single one of us, taxes, but not just any taxes. We're talking about the difference between active income, investment income, and passive income. By the end of this video, you'll be a tax pro, armed with tips to save more and give less to Uncle Sam. And stick around because I'll sprinkle in some humor and golden nuggets to keep you awake through this tax journey. Let's jump in. All right, let's start with the OG of income, active income. This is the bread and butter for most of us. Think of your 9-to-5 paycheck, freelance gigs, or that bonus you scored for meeting your sales targets. Active income includes W-2 wages, social security and short-term dividends, capital gains and interest. The key word here is active. You're trading your time, sweat and brain power for this money. Now, the taxman loves active income. Why? Because it's subject to ordinary income tax rates. The more you make, the more he takes. And don't forget about Social Security and Medicare taxes. That's an extra 7.65% gone before you even see your paycheck. Fun, right? Next up is investment or portfolio income. This is money your money makes for you. Because why should you do all the work? Here's the breakdown. Long-term capital gains and dividends. If you've held investments for over a year, you'll enjoy lower tax rates, usually 0, 15 or 20%, depending on your income. Short-term gains and dividends. Sell too soon, you'll pay ordinary income tax rates. Think of long-term investments as the VIP pass to lower taxes. Short-term ones, that's like getting stuck in economy class with the higher tax rates. Oh, and let's not forget royalties. If you wrote a book or patented something, that income counts as portfolio income too. Royalties are taxed as ordinary income unless tied to an investment. Now we're talking about the holy grail of income, passive income. This is the set it and forget it category. Think rental properties, businesses where you don't actively participate, and limited partnerships. The beauty of passive income, it's taxed at ordinary income rates, but you don't owe Social Security or Medicare taxes. Yep, no 7.65% haircut here, but hold up, it's not all sunshine and rainbows. If you're raking in rental income, you'll also have to deal with depreciation recapture when you sell the property. And if you're not careful, Uncle Sam's passive activity loss rules could bite you. Let's circle back to Social Security. Did you know that up to 85% of your Social Security benefits can be taxable? The government looks at your combined income, your AGI plus non-taxable interest, and half your Social Security benefits if you're over $25,000 as an individual or $32,000 as a couple. Congratulations, you've entered the taxable zone. Morale of the story, plan wisely for retirement, otherwise your golden years could feel a little tarnished. Now let's break down the two big tax categories, ordinary income tax and long-term capital gains tax. Ordinary tax, this is what you pay on active income, short-term portfolio income, and most passive income. It's tiered, meaning the more you make, the higher your rate. Long-term tax reserved for investments held over a year, this is the tax MVP. For example, if you sell a stock after holding it for 2 years, you'll pay 15% instead of your ordinary rate, which could be 24% or higher. And guess what? This applies to real estate too. Hold on to a property for at least a year before selling and you'll qualify for long-term rates. Win-win. Here's where the magic happens. Want to lower your taxes? Follow these strategies. 1. Max out tax-advantaged accounts. Use 401ks, IRAs, and HSAs to shield active income. 2. Harvest losses. Use portfolio losses to offset gains. 3. Diversify income streams. Balance active, passive, and portfolio income for maximum flexibility. 4. Invest long-term. Patience pays off with lower tax rates. 5. Use depreciation. If you're in real estate, leverage depreciation to reduce taxable income. Smart planning isn't just about making money, it's about keeping more of it. And there you have it. The ultimate guide to the different types of taxes. We covered active income, investment income, and passive income, plus strategies to minimize your tax bill. Now, it's your turn. 1. Hit that subscribe button and ring the bell. You know you don't want to miss out on more tips like these. 2. Drop a comment below. What's your biggest tax challenge? 3. Share this video with someone who's still confused about taxes. Sharing is caring and tax efficient. Remember, taxes don't have to be scary. With the right strategies, you can pay less and live more. Until next time, stay savvy and stay awesome. Peace.